The Reserve Bank's Monetary Policy Committee will meet on April 4th. This comes in a context of global slowdown, falling yields across the world and competitive populist packages within India, which of course can risk the fiscal balance. Ahead of that, I have invited the CNBC-TV18 Citizens Monetary Policy Committee to debate on the state of the economy and what action the Reserve Bank should take. Former advisor to the Planning Commission, former chief statistician, Dr. Pranab Sen is our chairman, as always, and members of our committee, Sonal Verma of Nomura, Soumyakanti Ghosh of State Bank of India, Sajid Chana of JP Morgan, and Somran Chakraborty of Citi. Gentlemen and lady, thank you very much for joining me in these deliberations. Well, let me start with Sajid this time. Sajid, you know, company after company on our channel are speaking of a demand slowdown. Not just autos, even staples are speaking of a slowdown. What's your estimate of the state of demand in the economy?
You know, I think clearly there are some pockets of stress in India. We know the auto sector has been under some stress because of tightness in the NBFC market. We know that agriculture has come under some stress because of the adverse terms of trade facing farmers. And we know small, medium enterprises have not been recipients of much credit from banks. But if you, and you know, it's easy to look at those data points and conclude that India is in the midst of a sharp, sustained slowdown. But that's not what the data is telling us. If you look more objectively at the high-frequency data, right, look at the PMI surveys, both manufacturing and services, look at cement production, steel production, non-oil, non-gold imports over a 3 to 6 month period, not any one particular month. And you look at the fact that credit growth has stepped in to fill much of the NBFC void and is getting slightly broader. For the first time, you're seeing credit both to industry and infrastructure. And if you marry all of that with the fact that core inflation, I always say the proof of the pudding is in the eating. For the last 6 months, core inflation has been stubbornly between 5.5% and 6% and reasonably broad-based. That is not consistent with a broad-based slowing. There are pockets of stress, but I would argue activity has stabilized. Let's not overinterpret the GDP numbers. They are contending against very unfavorable base effects. In fact, even in the last print, if you take agriculture and government spending out, core GVA actually accelerated despite having a very unfavorable base effect. So I would argue that while growth is not gangbusters, it's not collapsing in India as well, as core inflation is telling us. I'll just take 10 seconds because there are lots of global fears in the last week with the inversion of the US yield curve. There again, I think some of these concerns are overstated. Yes, the manufacturing and the goods sector have had a very weak start in 2019. There are particular concerns about Europe, but otherwise the high-frequency data in the US, particularly relating to consumption, households, labor market, wages, is holding up quite well. We think US growth will be close to 2% again this year. Most of all, policy has become very accommodative. With a huge pivot by the Fed, what you're seeing is financial conditions in the US have eased meaningfully, and there's a large stimulus underway in China. So even on the global front, we're not hurtling towards recession. We need to be careful not to overstate these risks.
Okay, thanks for that, Sajid. Soumya, I'm coming to you because I have just got your report which states the exact opposite. You're deeply worried about growth.
Yes, I think just to take the point from Sajid's point, I think if I just take a line and talk about the global growth, yes, what Sajid is saying that global growth may not be an immediate concern, but we are actually pushing back the global growth problem. For example, these talked about the US yield curve inversion, but if you look at the anecdotal evidences, in USA starting from 50s, you will always find there is a lag of around lead of 14 months from when the yield curve inverts and the recession sets in. So if that is the logic, then 2020 could be the beginning of a recession. So we have just front-loading.
I'm more worried about domestic growth,
yes.
Soumya, because I mean, as the largest bank, you would know how credit is moving.
Yes,
is growth worrisome?
Yes, I'm coming to that. So that's a concern, and that's why that is also being reflected in the exports. Okay. Now, if I take sector by sector. For example, if I take the rural sector, I think there is an indication of rural sector not reviving. If you look into the procurement, what is happening on the ground, that is actually completely differential across states. Some states procurement is very high, some states is low. So that is going to have an impact on the inflation. Credit growth, yes, credit growth has picked up, but it is not broad-based. For example, it is happening mostly in sectors like power, it is happening in sectors like roads, and it is happening in sectors for NBFCs which are well rated. And the most important thing regarding the capex, there is actually a decline in the capex. If you look into this order book of large companies like L&T and Well, there is a decline of around 15 to 20%. So yes, growth is a concern, and it will continue to remain a concern because external demand will remain weak. Domestic demand is not picking up, and the auto production, most of the companies are cutting back on production by 15 to 20%. And the NBFC credit spread, if you look at the NBFC credit spread, that's also an worrisome factor. And going into 2020, I think the NBFC sector will slowly pick up. So if I put all these factors juxtaposed into a simple argument, I believe that growth is a concern both at the global level and both at the domestic level.
Okay. Well, I've forgotten that the MPC's prime consideration has got to be inflation. So while growth will be the secondary objective, Shamiran, how should the MPC look at inflation? And the prime argument that everyone speaks in the market, real interest rates in India being very high.
Yeah, so if you look at the inflation dynamics right now, a large part of the decline in inflation because of food is just because of food prices, and what we need to really see that going forward, whether there is some kind of an elastic band effect where this significantly low food prices, they catch up or not, or this is more of a structural phenomenon where it's continuing at a low level for a longer period of time.
What is your thought now?
So the way we have looked at it is that we track on a daily basis the wholesale prices for the MSP items at least. And what we see is that there has been a pickup in the wholesale prices. So the MSP increase was weighted average about 15%. Till date, from the date of announcement of MSP, wholesale prices for those products are up about 9.5% to 10%. So roughly half, a little more than half of the MSP has been passed through in wholesale prices, but we don't see that at all in the retail prices. So whether these retail prices will now catch up at what point of time with wholesale prices, that's the big question. So I think willy-nilly we have already built in a significant pickup in food inflation in our forecast for FY20. But because we are starting from such a depressed level, that even with that, we probably get to only about 4% by the end of the year on inflation, which means for a pretty longish period, inflation is likely to be relatively benign, which should give some space to MPC, especially when I also agree with Shomo that there is significant growth risks.
Okay, so this 3.9% which RBI expected for the last quarter, you think it will be as good as that? Would it be higher than that or even lower, the fourth quarter inflation?
We were more or less in line with the RBI projection till the point where this week our oil analysts have revised significantly upwards their oil price forecast for the next couple of quarters to kind of around 75 to 80 range. Now that's if we bake that into our forecast fully, then we would probably be breaching the 4% mark. But that's still a little difficult at this point to immediately react and bake that in.
Okay. Well, Sonal, you have to put both growth and inflation together. How should the MPC think about both these parameters?
So I think clearly growth is a concern right now because you're facing both the global shock and the domestic shock. And I think India clearly has not decoupled globally. And while we've seen the consumer side in India slow down, we are clearly seeing growth actually percolate to initially discretionary, then non-discretionary. I think investment is where the next hit will come in. And I think one thing we should not forget is that the banks are largely taking up the credit from the NBFC space. And I think the divergence between the haves and the have-nots in terms of accessibility of credit, particularly in the commercial real estate sector, is significant. So I think the headlines are actually distorting and in fact hiding these still tight conditions that still exist for the SMEs, for the commercial real estate sector. So I think the next 2 quarters we need to be prepared for significantly weaker growth. What that means is that FY20 growth, our assessment is actually going to be below FY19, which was 7. We think the growth for FY20 will end up being about 6.8, with a very weak H1 and some recovery in H2, given the assumption of monetary easing. Inflation, given where oil prices are currently, actually the RBI's projections are already being undershot. And I think while core inflation has been persistent, core is not necessarily a leading indicator. And if the growth momentum is weak, which is what we expect, core inflation, which has been 5.5, will also come down closer to 4.5%. So headline inflation, we think, will undershoot. The 3.9% target that the central bank had, we think actually is tracking about 3.7%, so about 20 basis point lower. But this time around, the 12-month ahead forecast will also be out, which we think should also be sub 4%. So if you have a benign global environment, inflation sub 4 and global growth condition still extremely weak, then of course the question of monetary policy having the space to respond to growth within the inflation mandate, I think still very much exists.
Oh, we have a divided house here. Sajid doesn't think growth is that bad, and you three expect, estimate otherwise, and on inflation as well. There's a bit of divergence on how things will pan out by the 3rd quarter. Chairman, sir, you have to put all this together. And there is also another moving part. I mean, there are fiscal packages announced, and already one monetary policy cut and some liquidity. So given all that, would you say that the economy will pick up and it is at its trough, Dr. Sen?
Well, you know, my expectations are what we are looking at now, in a sense, is really not comparable to the situation we were in, let's say, a year ago. You know, liquidity has been eased significantly, and the indications are that going forward, that's going to continue to happen. The movement of liquidity from the banking sector into the cash economy, that's going to be helped whether you go through the BJP's Kisan program or the Congress's Nyaya program. It doesn't really matter. The government is already thinking of actually shifting that liquidity down into the cash economy. So there's a whole bunch of things happening. And I think what we are really looking at is a situation where in the immediate future, I think my sentiments are pretty much in line with that of everybody other than Sajid, which is the next couple of quarters you may see actually a slowdown in growth. But that's a lag effect. If you're taking a longer term perspective, I think growth is going to go up, and I have a sense that inflation too will start picking up quite strongly. Because I think we are tending towards an overkill in terms of liquidity.
Okay. Well, I am going to ask those questions of you, whether the Monetary Policy Committee should only look at rates, should it also discuss liquidity, what should the RBI do about liquidity? So it's time now we discussed what the MPC should do. So Sajid, you tell us first, is there space for one cut, 2 cuts, by which I mean 50 basis already on April 4th, and what should we expect on liquidity?
Latha, I think the MPC made clear that, you know, the focus of monetary policy will be to be consistent with the legislated mandate, which is that if inflation is below 4%, then the MPC has some space to ease monetary policy. And what we're seeing is that there's this huge divergence between food inflation and core inflation, and that divergence continues to sustain. In the latest print, core inflation actually accelerated to almost 6%, it's 5.9, but food inflation remains very benign. That said, over the next 6 months, we think inflation at a headline level remains very benign. Our average inflation forecast is for the next 6 months just about 3%. So to the extent that that is the outlook and the MPC is focused on the headline target, I think there is perhaps space for one more cut, and so we expect the MPC will cut rates in April. However, as we've mentioned in the past, we continue to believe that over time it is headline that gradually gravitates towards core and not the other way around. So I'm not sure there's space for a large easing cycle here, probably a cut in April. Also, inflation expectations have been quite sticky in this range of 7 to 9 for the last 3 or 4 years. So we believe, yes, there is space for one cut in April.
Okay. Shawya, if you can continue with this argument, what should the Reserve Bank do on rates? And rates looks inadequate now because the previous one hardly got passed on, rate cut. So, therefore, the question to you is, what should they do on rates and, more importantly, on liquidity?
Yeah, I mean, the problem is that, and you asked me before about the real rates, and the challenge is about ex-ante real rates versus ex-post real rates. So, if we are projecting inflation at 4% plus 12 months ahead, then your ex-ante real rate is reasonable. But since we are constantly almost achieving the actual outcome at much lower than what the projected inflation is, the ex-post real rate is turning out to be much, much higher. And that's something which the MPC needs to think about, that whether we can operate with as long as a 12-month horizon on inflation forecast, or we should be looking at some kind of putting more weightage to near-term forecast and less weight towards the longer-term forecast. So that sort of a thing could drive a bit more dovishness into the MPC thought process. But the transmission bit, to be honest, it's not really MPC's core mandate. It's more lies with RBI about what kind of instruments that can be used. I don't think the April policy will give you any clear indication of a OMO calendar for April, May, or even some idea about how many more FX swaps are going to come, because this is going to be a tricky couple of months of liquidity because of the election-related oddness that it introduced into the liquidity assessment. So
I don't want you to get bogged down only by what is the MPC's mandate. Basically, if you think the economy is weak and rate cuts are not helping, should we go a little more all out on liquidity is my question.
Absolutely. So if you look at a slightly broader picture, the fact remains that we are targeting kind of a fiscal number which is lower than last year, the fiscal deficit. So there's no question of a fiscal stimulus. So if growth is weak and it needs a bit of support from policy, that has to come from the monetary policy side. And because inflation is relatively low, you have an option of easing somewhat. And then it comes to how do you pass on that rate cut onto lower lending and deposit rate. In my view, that can only happen if you are proactively committing towards keeping liquidity ample in the system. Now, how do you do it? You can do it through a calendar, you can do it through proper guidance, but that bit needs to be communicated better. The market still seems to believe that RBI is keeping liquidity a little tighter.
Okay.
That's the belief in the market. And it's all about how you communicate here, because this forward guidance is very important on liquidity for rates to actually pass on, because we have a structural problem, let's not forget about it, which is about a saving investment imbalance and crowding out. So those things are there at the back. I'm not ignoring that. So if you have those problems, then how do you transmit relatively easier monetary policy onto lower lending and deposit rates?
Unfortunately, you're running out of time. Sonal, the question I'm trying to get at is, should reverse repo become the guiding force? I mean, should RBI move to surplus liquidity? As a Monetary Policy Committee member, what would you do?
At this stage, I think we shouldn't. But the point is that transmission will happen. Transmission usually takes multiple quarters to happen, so it will happen. Currency leakage has partly been high because of the elections, so post-elections currency leakage should come down. And if growth is slowing down, you should also expect the incremental credit accretion going forward to be less than what it has been in the past. So the incremental credit deposit ratios will also ease. So things might look extremely tight right now, but I do think over a period period of time, given the macro dynamics we are considering, given post-elections. I do think transmission will happen, but slowly. My concern, Latha, is that I think we're seeing a very, very segmented economy, that the entire transmission is only happening largely in the consumer space. And like I said, the divergence between haves and the have-nots, especially the sectors that really need money, I think that's becoming extremely wide, and that's my bigger concern.
Yes, there is a trust deficit with respect to several NBFCs. I take your point. But, okay, let me get to Soumya. Do you think the policy stance should change? I mean, even if the RBI doesn't make reverse repo the, guiding force, put so much liquidity, should it, change its language to accommodative from neutral?
Yes, I think for an answer, I'll just take 10 seconds to, to address one of the concerns of the liquidity framework. I think there the market needs to be communicated better, because you can't have a repo and then CD spread which is close to 200 basis points when the liquidity framework is actually supposed to be neutral. And the problem which Sajid says is that now frictional liquidity is substituting durable liquidity injection. So that is one point, because durable
we have done a lot of durable liquidity.
Yes, but the durable liquidity outflows this year has been around 5 trillion, including that because of the global market, external market turbulence, to be fair to them, 5 trillion, but the RBI has done OMO up to 3 trillion. So they have done enough OMO, but the withdrawal has been so much that there has been some element of substitution. Now, having said that, in terms of the stance, I think yes, given the current growth condition, given the fact that growth is going to remain weak for the next couple of quarters, I think you need to cut rates, given that you have to do the policy heavy lifting to the monetary policy, and possibly one rate cut will not suffice, possibly a larger rate cut will suffice, but the issue is that whether you need to cut at a larger rate, more than 25 at one go, or you want to spread it over. In any way, even if you want to cut it by, say, a larger than 25 basis point, you need to change your stance, or even if you want to cut by 25 basis point, you have to give a clear signal to the market that we are here for a dovish policy. So in that case also, I think there is a strong case for changing the stance from neutral to accommodative.
Okay, very quickly, Sonal, do you want reverse repo to be the signaling rate? No.
Not yet, Latha. I think definitely the liquidity deficit needs to be close to zero. So the spread shouldn't be substantial. So that is a precondition to ensuring that transmission happens in a rate cutting cycle. I think the fact that transmission takes time, is a fact, and therefore, while transmission may not have happened as much, I'm just making the point that if you keep liquidity around neutral, the transmission will happen over a period of time, and the currency leakage, if it does come down, that will also ensure better transmission.
I'm getting a sense that Sajid, Sonal and Samiran are not going for as much of loose liquidity as perhaps Soumya is arguing. Well, Dr. Sen, the last word, sir. What should the Reserve Bank do in terms of rate action, in terms of liquidity? And you were the one who is warning about overkill.
Yeah, my sense is that the RBI will need to actually, and this is a timing issue rather than what should be done. I think liquidity has to be increased. Rates will eventually have to be cut. The question is, which do you do first, which do you do second, do you do both simultaneously? This is a strategic issue. My own personal view on this is that RBI is going to be focusing on the liquidity side for the time being, and they will worry about rate cuts a little later. The rate instrument, I think, will be something that will come post-elections. That's my personal view.
Okay. All right. Gentlemen, you have put, I think, all the relevant factors on the table. It's time you take up your pens and vote. The first question I'm going to ask all of you is, what rate action should the Reserve Bank cut or stay pause? And if it cuts, how much? So first, that question to you, Sajid, cut or pause, and if it's a cut, how much?
25 basis point cut in our view.
Okay. All right. Okay. We need to see your board as well. Samiran, what are you expecting?
25 basis
25 basis rate cut. Okay. Sonal?
Yeah, 25 basis point rate cut.
Okay. Fine. Soumya, what are you expecting?
We're expecting a 25
basis cut. Okay. Chairman, sir, would you disagree?
Yes, I would.
Yes. Okay, well, the chairman has a reputation of calling the market, calling the MPC right in the past, even when he is in a minority. Now I want to know about the stance. Sajid, at the moment it's a neutral stance. What would you want? Some people are asking for accommodative. What is your expectation of MPC stance?
We think that the neutral stance, which gives the RBI to be very flexible in all directions, is appropriate.
Okay. Neutral stance, what's your...
It's a maybe from me.
Okay.
There is a possibility.
You mean maybe they will change
Maybe they will change it.
Okay. I mean, I would really wish if you vote one way or the other, but Sonal, is it going to be neutral? Is it accommodative?
I think they will keep the stance at neutral.
Neutral-ish. So you also like kind of not very sure. Shaumya?
Yeah, I believe there is a possibility of a rate stance to accommodative.
Okay, okay. Accommodative. So actually, a lot of you are veering that the neutral stance may change. Dr. Sen, should the stance change? Neutral. Well, the chairman is very clear that we shouldn't go for overkill just yet. Let me see if I can squeeze in a third question. Sajid, how many rate cuts are you expecting through 2019, counting April? 25, 50, 75?
Yes, including April, it would be 25, at most 50 basis points.
Okay. Well, Samiran?
It's 50.
50 basis. So April and one more cut. Sonal?
Yeah, 50 basis points.
50 and one more cut in the future. Shaumya?
50 BPS, but with a possibility of an upward bias if growth doesn't pick up.
But you are expecting the 50 to come on April itself?
That will depend on the rate stance.
Okay.
So that's then.
Dr. Sen, how much of a rate, how many basis points will rates fall in 2019? 50 basis. Okay, there is unanimity over here that a half a percentage point rate cut through 2019, only on April 4th itself. 4:1, the expectation is of a 25 basis cut. A little undecided as far as the stance is concerned. Many people expecting, I mean, that it could become accommodative. Chairman, Dr. Sen and members of the Monetary Policy Committee, thank you very much for an extremely enlightening and enriching discussion.